the economy is getting back towards normal. Not normal yet, to be sure. But it does seem that the close races, which will take place next November, not this November, but the following November, are already starting to weigh on decision making in terms of fiscal policy, both spending and taxes. The bottom line is spending will likely not be as high as President Biden's proposals, and taxes, surprisingly, we think are starting to move back into a capital-friendly stance. So that's very interesting. These are 10 swing states for the Democrats. Those are the results. And it does seem as though the talk around spending is starting to sound a little bit like there may be something more bipartisan than otherwise might have been the case. And it does seem like the tax talk is now more around corporate taxes, but not corporate taxes going up, tax rates going up from 21 to 28%, but now this minimum corporate tax at 15%. So every corporation who has not been paying taxes pays at least 15%. That seems to be the direction in collaboration with the European Union, or the G7, I believe. So that's very interesting. This means we may not see a capital gains tax rate increase, which would be phenomenal, and I do believe the market is starting to respond to this, nor a corporate tax rate increase, certainly not to 28%, maybe a few percentage points, but even that seems to be diminishing in probability. So I would say on the fiscal policy side of the equation, relative to our fears, certainly, about capital unfriendly policies, and certainly policies unfriendly to innovation, we are beginning to feel a lot better. Now, if we go to the broader report, which is the consumption report that's in the GDP accounts, if we look in April, what happened to personal consumption expenditures, and I'm going to adjust them for inflation to highlight this point about unit volumes. If you look at real consumption in April, it was down slightly. But if you look at real goods consumption in April, it was down 1.3%. Now, this makes sense because if you look at the past year, real goods consumption increased 74%. Think about that. In the last year, the consumption of durables has increased 74%. And so now that the consumer is filled up on durables and I'm sure non-durable goods as well, the spending towards services has begun. And we did see services consumption up 0.6% that month. So that's very interesting. That's in real terms as well. Now, the reason the market is on edge about inflation is some of the indicators are coming through much higher than expected now. There are two reasons. We've been talking about this probably for the last 6 months. The base effect. Last year at this time, in the futures market, energy prices had just finished going through a negative session, which of course is not possible in the spot market. But that just gives you a sense of how much pressure there was on prices at this time last year. So there could be some impact from China. But one other indicator very important to us is beginning to confirm that this might be a little bit more real than the skeptics would suggest. The Treasury bond yield has dropped from 1.75%. This is the 10-year Treasury bond. So 1.75% to 1.55%. And today we got the wages higher than expected. We've seen inflation indicators higher than expected, as I just mentioned, and yet the bond yield is going down. This reminds me a lot of 2006. The bond market got that one right as well. Energy prices soared from 2006, I think they were at $60, all the way to $140 in the spring of '08, even though the writing about housing was on the wall. Maybe it wasn't on the wall in 2006, but that's when the bond market began to see it. Even with the shocks we've been through during this first half of the year, interest rates doubling, the 10-year government bond yield doubling in 3 months. That's never happened. Never happened before. We got through that, and the market was up at the end of the first quarter. Now bond yields are coming down. That's very market friendly. We also had the fears around Archegos, the domino effect associated with leverage. That did not happen. We had the fears of capital gains tax rates nearly doubling introduced into the equation in the second quarter. And still, the market continues to move forward. We believe, as we've been saying for quite some time, that the bull market is alive and well, and it is broadening towards value and cyclical sectors. Or maybe I should say it has broadened. This has happened, and we thought it would. And we thought it would hurt innovation-oriented strategies. It has done that as well. Now, if we're right and everything I just suggested based on the evidence we're seeing occurs, then these cyclical sectors are setting up for a fall. And that should accrue to the benefit of innovation. Why is that? Well, when we get into a recovery, the early stages of a recovery are when the cyclicals see a burst in revenues and earnings. And they give more growth-oriented and innovation-oriented stocks a run for their money. These growth rates are competitive. They're not sustainable, but at least they're competitive in the short term. And very much of the market is short-term oriented. As you know, our investment time horizon is not 1 quarter or 1 year. It is 5 years. So our innovation-based strategies are suggesting that the returns available or likely, can't promise anything here, of course, to innovation-based strategies have increased. I mean, it's just arithmetic. Our price targets have not changed. The prices have come down short term.